Hey, Alex, happy August.
Thank you, Kiah. Happy August to you. Are you excited to go back to school soon?
I was just going to ask you if your kids were back in school and I feel like the oldest person in the world right now. Uh, Nashville, I believe, either went back to school this week, and then
Mm,
some other counties had gone back to school last week. And
mm.
I have distinct memories, I think, from high school of going back to school and then having a day off for Labor Day and being like, why didn't we just like push it back by like another week, right? Like, why
Hmm.
are you
Hmm.
why are you making me go back to school for like, I don't know, it'd be like Wednesday, Thursday, Friday, and then you got Monday off, and then
Yeah,
we would have like regular school. And I'm very confused why kids are starting school so early.
it's a great question. I mean, I think so. In Montana, we always start a little later than I think other parts of the country do,
Okay.
and that is as I understand it, that is a legacy of farming communities needing the kids to bring in the last bit of the harvest before they send them
Yes.
back to school. Bozeman's probably not as much that type of town anymore, so I don't know exactly why that continues to hang on as a tradition.
Hmm.
But I can tell you, having now been on the other side and watched young kids enter the school system a couple of times, because I have two in elementary school now. One of the things they do, which I do think is smart, is they'll do like weeks for different grades almost.
Okay.
And so it's like if you're starting kindergarten, you start like with a 3 day week. And then that rolls into post Labor Day start for everyone else that goes a full week. And so it's kind of like scheduled around the long weekend to ease in certain
The
parts of
acclimation
the.
of like a
Mhm.
school schedule.
Yeah, and just like the
Yeah.
mechanics of honestly, kindergarten is wild because it's like you're watching them and it's like how to walk in a straight line, how to get everyone into the classroom in a timely fashion, how to take off your coats and hang them up and sit in
Yep.
your chairs. Like we take for granted now that like we're all pretty capable of like
We were
following
all
basic
potty
instructions.
trained in the school
Yeah, like
system. Yeah.
yeah, like we have the basics down now, but my goodness, like I watching kids go into elementary school, I have so much more appreciation for elementary school teachers than I did before because it
It's
is
incredible.
you're teaching them the real basics of how to be a human.
Yeah. Well, are you ready for fall conference season?
No, I am not. Don't like Kia. That's not happening. I still have a couple weeks left. So don't say it like that. No, I'm excited and also nervous because I have a
Okay.
lot of travel coming up.
You have a lot of travel. That's a long
Ye-
list at the bottom of your newsletters.
It
Yes, I've seen
is.
it.
It is. It is. I the thing that's funny is I keep getting these late invites to things, and it'll
Hmm.
be like, "Hey, can you come do this thing at this week?" And I'm like, if I add one more bit of travel, some combination of me getting fired and me getting divorced is going to happen.
Oh
So
yeah.
no, I cannot add like one tiny iota more of fall travel. Like my schedule is locked at this point. So no, it is elating in the sense that I'll get to see a bunch of people, including you, out on the
Yeah.
road, which I'm very excited about.
Upfronts and Money 2020.
Yep, yep, yep. Maybe a trip up to Toronto to see our friends in
Oh, that's right.
Canada.
I forgot I'm going to Toronto.
So we have a whole set of things, a bunch of different topics: open banking, AI, standard setting, all kinds of
Oh my
fun
God.
things. But no, I'm also equally terrified by just the sheer amount of logistical work ahead and
I
making sure
know.
that the newsletter and podcast keep going. Like maybe Kia, we should just record like the
We
next
should record on
four
the
bank
road.
nerd corners. Oh, I like that
Yeah.
idea. That's a
We
good
should
one.
record on the road. Yeah. I can't
Okay,
believe we always just hang out, and what we should be doing when we're together is
content.
working. Yes, content all the time.
That's a good idea. A future bank nerd corner will be recorded in person. How about
Oh,
that as a commitment?
absolutely. Yeah, it's a
Okay.
promise.
All right.
Okay, well, you actually kind of alluded to our first topic, which is the hottest topic, I think, right now in the very specific space of people who remember when banking as a service was a giant problem for
Sure.
the industry, which is the news that our friend Evan at Bloomberg Law reported that the FDIC is floating a standard setting body for bank and fintech partnerships. And if you have been living under a rock for the last week, it looks like the FDIC is working with the ABA, the ICBA, the Bank Policy Institute, the Financial Technology Association, the American FinTech Council, and the Coalition for Financial Ecosystem Standards to
Hmm.
establish an independent standard setting body that would certify whether bank service providers meet federal regulatory guidelines. And I've been very curious about the absence of a standard setting body, in part because, your bank nerd friend, Kiah, is a big fan of SROs and independent standard setting bodies. So SRO is a self-regulatory organization. We have an SRO in the securities industry with FINRA. And then we have, my favorite is the Financial Accounting Standards Board, which is the group empowered by the SEC to create accounting standards in the United States. And then there's obviously like SOC 2, I guess. I learned SOC 2 came from the American, the association, it's AICPA. I used to go to, it's a CPA organization, and I used to go to their bank conferences. So I was but the AICPA, while CECL was being kind of debated and different banks were like getting ready for it, the AICPA was like, how are we going to audit for this? What kind of questions? Like they were like this like kind of practices group. And so, going back to the story, the FDIC is in, and its industry partners are in early planning stages. They held their first meeting like a week ago. There's going to be another meeting. And then Evan wrote that the agency is likely to move quickly, in part because we are getting new third-party risk management guidance as well. I know that we needed a fourth or fifth iteration of that. So, Alex, is this going to solve all of our problems in banking as a service? What are your thoughts?
No, I don't think it probably will. I think that, I guess with my standards haven't been lowered so much over the last 18 to 24 months. I feel good that something's happening. So that's, like if my expectations can be low enough, then anything can like make you happy. And so in some senses, I feel good that the FDIC has convened this group together and has been advancing this. Obviously, I think you and I have talked over the last couple of years about CFDS and some of the movements towards standards and standard setting. So I think this is in some ways kind of a continuation of that. And a lot of that either came out of or at least was dramatically accelerated by the collapse of Synapse and sort of the worst case scenario playing itself out in banking as a service. Having said that I do see a number of issues with what's being discussed. And it's very early, right? Like in Evan's reporting, he was like literally like the first official meeting with all these different groups happened like the week before he published his story, and more meetings are happening. And right now the FDIC is kind of spearheading it, but they're bringing in the OCC and presumably other agencies. New joint guidance from all the federal agencies on third-party risk management will be coming out, which will be, I would imagine, somewhat harmonized with this effort. So there's a lot happening. I guess a couple just sort of weird things that jumped out to me. One that I want to get your take on, Kiah, is you and I have talked about this before, like standards only work, and certifications maybe is an even better thing to hone in on, only work if they have sort of teeth and if they mean something, right?
I would agree with that.
Yeah. Like, anything like this, like grades in school, if everyone gets an A, then no one really gets an A, right? Like this is just sort of, it has to have teeth. There have to be consequences if you don't.
There has to be a downside.
Whatever the bar.
Right.
There has to be a downside.
If there's a lot of upside, right? This, like, I think there's clear upside, but yes,
totally.
I would agree with that. There needs to be downside.
Right. Like some people necessarily have to lose in order for this to actually make sense and to work well. And I'm curious to see how that plays itself out because, like, for example, are there any organizations that wouldn't meet the standards? Is meeting the standards, does it really mean anything? Is it required that you meet and are certified against these standards in order to work with a bank? Well, if a bank chooses to work with a third party that is certified, does that offer them safe harbor against regulatory actions in the future? Like all of these sort of get to this question of like, how much teeth does this really have? And like, are there actual meaningful both benefits to people who pass the standards and consequences for those who don't? And I guess I would say that Evan's reporting, and then he included like a draft of like the sort of terms that had been floating around amongst the different participants who were involved. So you could review the kind of lengthier document. He linked to it in his story. I would say the answer to that question seems decidedly mixed. in his reporting and in that document. But what's your take on that question?
Okay, this is like a little stupid of me,
Okay.
but I'm going to say this standard setting organization would be for the fintechs that partner with banks, right? It wouldn't be for the banks?
It would be standards that third parties, not just fintechs, but like any third parties,
Sure.
would need to meet in order to be considered, quote unquote, safe for banks to work with. And so
Sure,
it
okay.
would be the standards would be applied to the third parties, and then the banks would use the standards and then the certification that goes on top of the standards based on independent assessments that are done in order to make more informed decisions about which third parties to work with, and I guess theoretically to speed up the due diligence process that banks normally do when onboarding new third parties.
Yeah. I do think I guess like I think that the issues that have presented themselves with banking as a service and other types of third-party partnerships are serious enough that they deserve, like, they deserve to be solved or addressed. And I guess the question is like, is there a way that we can get 30% there and everyone knows we're 30% there and then everyone else has to do 70%? But I also think, based on what I've seen from not, the best of the banking as a service banks, but, just some of the questions I've seen in the industry is like the banks want the FDIC to do more.
Yeah.
And I don't know why the FDIC doesn't want to do more. I guess, like, and I think the other thing too is that I'm not actually sure really how standards exist without enforcement. I guess, like, to your point about grades, would the standards create like A, B, C, D, and F? And then like C and above is technically passing, or is it pass fail, or is it, everyone gets a gold star because you went through the process? The other thing too is, and I think I emphasized my love of standard setting organizations because I think that, while they're not perfect, they are like kind of an elegant, imperfect solution.
Sure.
In that, people believe the counterparties, but that, like, what I want is for an auditor to get in and kick a lot of tires and then to put their qualified opinion on the first page of the annual results for all of us to see. And then I want, and this is such like a public company thing, but I want like material weaknesses, right? And like, I want a really strong BSCA, and that's not this.
No.
Because I think the BSCA exists. And then I also want, I want something that shows the FDIC and the OCC and the Fed learned from banking as a service, and not that they're covering their ass from the next time something happens. Does that make sense?
It does. Yeah. I mean, so picking on a couple of those different threads, I mean, one of the ones that's really interesting about this is, you mentioned the BSCA. You mentioned, which is the Bank Service Company Act, for those uninitiated. For those who don't,
if you're new
have
to the podcast
t-shirt.
and you haven't,
Yeah, if you're not like part of the fan club, like, we'll send you a T-shirt. But BSCA is like a law that was passed. You mentioned self-regulatory organizations. Kiah, are you familiar with the Horse Racing Integrity and Safety Authority?
I'm not, but I'm just south of Kentucky, so I feel like
HISA.
I can't believe I've never heard of them.
It's the best, yeah. So this is, in doing the research on SROs and SSOs, the Horse Racing Integrity and Safety Authority is a private self-regulatory organization that regulates the sport of thoroughbred horse racing in the United States. It is empowered to sort of enforce government standards, but privately, much like an SRO is. But, and this gets to the question of like how this work by the FDIC is getting done, the Horse Racing Integrity and Safety Authority is something that's actually since 2020 has actually been like given formal authority by congressional action. A law was passed to empower it, right?
Sure.
I somehow missed that in 2020 when we passed that law. I wasn't paying attention to that.
Yeah.
But it kind of gets to this broader point of like, under what authority is the FDIC doing this? And then how does that authority translate to how sort of sticky these standards become, right? Because an overly simplified way of describing it would be something like you, the banking regulatory agency, can issue guidance, which they do all the time. And third-party risk management is an area where they frequently issued guidance and then updated guidance and then revoked guidance and replaced it with different guidance. Apparently, new third-party risk management guidance is coming, according to Evan's reporting. That has the benefit of being something that you can update frequently. It has the benefit of something that you can do that is quick and doesn't require public comments. It doesn't have to follow the Administrative Procedures Act. Like, it's very quick and easy to do, which isn't to say that it's perfectly easy to do, especially if you're doing it across agencies and everyone has their own opinions about stuff. The next level up from that is like actual rulemaking, which from what I understand, at least so far, is not being contemplated with this. So I don't think they're planning to do any formal rulemaking to enshrine this as regulation. And that is beneficial because now you don't have to wait, you don't have to get annoying public comments, you don't have to go through the whole APA process. And in particular, if you go through that APA process to actually create formal rules, you have to codify exactly what the standards are in the rule. Yeah. And then if the rule changes at all, or if the standards change at all, you have to go back and go through that whole process again to update them. So it's a very easy way for like things that are supposed to be prescriptive, like standards, to get kind of frozen in time. And so I think there's a very logical reason why they're not going through that rulemaking process. But going back to the point you made earlier, you and I can't submit a comment about what they're doing. The different sort of industry stakeholders can't. And you might say, okay, well, aren't the industry stakeholders participating? Like all the trades are involved on the fintech side and the bank side. Isn't that good enough? Well, I know for a fact that the consumer advocacy organizations will have a say about this. They'll want to have their say and give input. I don't know if they're involved in this. So the lack of like public comments is a problem. And then the third level is, well, you can actually pass a law that gives formal congressional authority to a standard-setting body or to a self-regulatory organization. And that would be kind of the most formal and permanent version of doing this. And the reason I mention all of this is just that in the draft terms that were being circulated and that Evan shared in his reporting, it was really weird because at one point in the document, they say this would not provide a safe harbor, right? So if you're a bank and you choose to work with a third party that is certified under these standards, and then something happens and turns out you picked the wrong vendor and you get in trouble with regulators, you can't go back to them and say, well, I picked from the registry of approved certified vendors, like I shouldn't be getting in trouble. There is no safe harbor. But then later in the document, it basically says, it doesn't use the word safe harbor, but it basically says, no, actually there is a safe harbor. And we will not go after you at all if you pick from this list. So to use the specific language, it says federal and state examiners will accept a bank's reliance on certification and that the agencies will, quote, not take adverse supervisory or enforcement action against a bank with respect to the onboarding of a third party that received certification. So even within the document itself, it contradicts itself. Like that, like what I just described is functionally a safe harbor, even if you're not using that language. And the thing that ties back to the how, right, is this guidance, is this rulemaking, or is this a law? Is if it's a law, then it's a law, and that's just the way it is.
Yeah, then
there's no undoing it unless you go back and change the law. If it's rulemaking, it's at least semi-permanent because it's on the books. It went through the APA process. It went through notice and comment and all these different things. And in order to unwind it, you have to go through a similar process to sort of unwind it or replace it. If it's guidance, then on day one of a new administration, with new agency heads at the OCC and FDIC and Fed and maybe the CFPB if it ever is brought back to life, they can just unwind it on day one. And so that whole thing about we will not take adverse supervisory or enforcement action, that's just a promise if it's guidance that's being made by these regulators, not by regulators that you might have, 2-3 years from now. So I think there's a real question about just structurally how this is being done and how much, Because ultimately what you want is you want to give banks and fintech companies reassurance that they can work together and do so in a fast, efficient way, and like do so with a level of confidence and not like be too overly conservative or slow or, too worried about the risks. But if this guidance could just get washed away, I don't know that it creates that certainty.
The other thing too, and I don't fully understand what problem we're solving for here, because I understand what I think the problem was, or some of the problems have been, and things that I wish were different. Like in my head, I could also put together a group or put together some standards that I think like we should solve for, and that I want fintechs to take accountability for the role that they had in causing these issues.
Yeah.
And maybe the standards can do that. Maybe the standards can outline the liability and the customer relationship and reconciliation and access. And then I would have no problem, I guess. Like, even if they're not enforceable, if every fintech that like got examined standard, their gold star, like could say, we will keep a reserve amount that would have, or an insurance policy that will serve as essentially de facto fintech deposit insurance. And that in the case of a wind down, the following things will happen so that our end customers won't have, their money will be frozen for 2 years. I guess like we could do that, but I also, if we are not doing that, if we're not solving for that problem, then I actually don't really know who we're solving for. And I don't know, like, why would a fintech want to participate in this? But yeah, I don't know. Part of me, like, we were so unserious about what happened with Synapse and some of the other like third-party fintech issues that we've seen, some of the bad behavior. And I also think that like we haven't punished like any of it. Like, one of the whole jokes about me in crime is like, I didn't know it was legal to like just misplace $60 to $90 million.
Yeah.
And so like we could start there. We could start there with some standards, and we could outline like some things you're not supposed to do and whatever. But like, I just don't feel like anyone is like raising their hand and being like, I want to be held accountable for this. And like, if I can't be held accountable, I don't get to play in the ecosystem. You know what I mean? And I don't think the FDIC should just participate in that. I think it's such a bad look for the FDIC to like lend its name like that,
Yeah, it's fair. I mean, I think to your point about accountability, like, you only have accountability if there's a punishment if you do something wrong. And like the terms that have been circulated, they don't talk about liability at all. And liability is like the capital L word that no one ever wants to use, because as soon as you use it, then everybody flees to their corners and doesn't want to cooperate. But like, you're right. Like, at the end of the day, like, just as an example, if, like, let's just say, if a vendor, a third party, which could be like a fintech company working with a bank in a banking as a service context, if one that was certified, right? So independently assessed against a agreed upon set of standards, certified as having met those standards, which would translate into them being considered, I think, the way that the FDIC and the terms being circulated contemplated as like certifying them essentially as a reasonable risk to manage for a bank, right? A reasonable risk. And then that fintech company blows up and causes customer money to get lost, or causes some huge operational issue, or something bad happens. Who gets in trouble for that, right? Like, what is the liability? What is the accountability for that? And I think, the way the banks would look at it is to say, well, look, we picked off of your certified list, right? We picked the quote unquote safer vendor to work with because they met these standards in the certification, and they're going to want some level of protection against being liable. Because right now, the only parties that legally are like the throat to choke in any of these scenarios, including Synapse, is the bank. And we saw Evolve Bank get a consent order way after the fact. and for a number of issues, some of which related directly to the problems they had, and some of which were kind of tangential because they were just a badly run bank. But like, I didn't really feel like they were held really accountable in a meaningful
there was no
way.
fine. There was no fine.
There was no teeth
tell me
even
like
in
what,
that.
like I'm sure
What
the
happened?
bank, right? Like, did anything get harder? Because the bank was already going through a hard time.
Right. Like, it
kidding?
wasn't. I mean, like, I would have been fine with just the bank going away. That seems like a reasonable punishment for the level
customers are losing that money. If it
No,
exists,
right.
they're losing it.
No, and I mean, like, and there was no fine, and so I think that certainly there was no, even in the part of the value chain where supposedly there is some level of accountability, which is regulator to bank at the end at the bottom of the stack, there wasn't meaningful consequences. No. But if you extend that backwards, there was no meaningful consequences for Synapse, apart from having failed and the founder walks away and founds a like killer robot company. Like, none of these things really ended up mattering for Synapse. And by the way, it didn't really end up mattering for, fintech companies that, based on our friend Jason Mikula's reporting, weren't always making responsible decisions, the type of decisions we'd want them to make, like a Mercury or a Yada or a Copper or whoever else. So if there's no consequences for anyone, then I don't think the standards overly help. And this, I guess, is the last point I'll make, and it kind of ties to our next story a little bit. It's particularly difficult when not only do the standards not have any teeth or consequences associated with them, but also when the standards are broad enough in what they're trying to assess or cover. Because the more room there is for sort of like interpretation or the need for context, or like, oh, this is a little bit of a different thing than this one, like the more nebulous the standards. And when you're assessing the overall risk of working with a third party, that is by definition sort of nebulous and broad. I think the harder it is for the standards to just even be useful in terms of like driving the right behavior, right? If you go to the other end of the spectrum, like we can use open banking as an example, with the work that the CFPB and others have done over the last few years on open banking regulation, they didn't really contemplate like broad operational standards for any parties involved in open banking. The only standard part of it was the specific technical standards for how the APIs would work. And that was something where they wanted to empower standard setting organizations that were private and to do that. But like the scope of it was so narrow just on technical standards. Like to me, if you're not going to have teeth or consequences involved at all, then by definition, any standards that can still be useful in that context need to be really narrowly scoped to very technical things and kind of leave the broader like value judgments about, is this company a good one to work with or not? Just leave that out of it entirely if there's not going to be any consequences.
Yeah, I guess my final comment on this is thank God reputation risk doesn't exist anymore. So banks don't have to worry about that when the FDIC kind of comes up with their... it's a phrase. I know that I'm just going to irritate regulators, but like good housekeeping seal of approval. And if you don't, you know what I mean? Like if you don't want your thing to be a good housekeeping seal of approval, right? Like you're going to have to make some design choices, but no, it's all, everything is trade-offs, right? And it felt like in this particular case, at least at the moment, and this is all in progress. Yeah, we're one meeting in. We might be two meetings in.
So room for changes.
Let's see if bullying works. Okay.
It does feel like they are optimizing for everyone agreeing and being at the table and being happy rather than having like standards with real teeth. But we'll see.
Alex, can you walk me through this next story? Because it kind of like breaks my brain a little bit, but I think it's ultimately interesting / maybe good, probably positive. Yeah,
absolutely. So Solo, or I guess Solo Network, is a sort of a fintech infrastructure company network that is running a new pilot. So for a little bit of background and context, the way that sort of like customer verification has worked in financial services for a long time is that every individual financial institution would verify the consumers and businesses that they were working with. And that wasn't necessarily because that work had not already been performed by someone. Like these weren't necessarily net new customers to the financial services industry, but they were new to the individual institution. So the individual institution would do all of the sort of manual work to evaluate, verify that this consumer or this business is who they say they are, that they're allowed to work with them, and do all of that sort of risk management work that you're required to do for KYB, KYC, ultimately like customer information programs, which is a requirement under anti-money laundering guidance.
Okay.
So that's how it's traditionally worked. What Solo is doing with this pilot is basically trying to build a network that will allow for individual institutions to standardize how completed verification work that they've done is represented, evidenced, audited, and independently evaluated. So the idea with this is if you participate in this network, then you generate standardized, auditable verification artifacts that document the work that you've done to verify this customer is who they say they are. And essentially what that does is it allows these sort of trusted verification artifacts to become reusable across the network, which would allow other institutions to then sort of use those building blocks to independently, and they still have to do the work themselves, but independently verify these customers are who they say they are. So instead of starting from zero, you're starting from 20% of the work has already been done, or 40% of the work has already been done, or 80% of the work has already been done. So essentially the question is, why are we having every single bank, including these small little community banks that don't have a ton of resources to do this stuff, why are we making them completely reinvent the wheel from scratch every single time rather than creating some way to share this information? So that is the pilot that is currently being run. Apparently it is a pilot that involves a number of, different participating institutions in the financial industry, but also is being observed by different regulatory agencies. And so not kind of similar, I guess, in some senses to the first story. I don't think this is like being convened or driven by any of the regulatory agencies, but they are looped into and watching how this works. And, I think as you said, I think it's very interesting because this is one of those areas where I think everyone kind of conceptually agrees, like, yeah, it's silly that we do it this way. But the difference between kind of conceptually like, oh, wouldn't it make sense to share this instead of just doing it from scratch every time? The difference between that kind of conceptual idea, which makes sense and everyone agrees with, to the actual reality of like, okay, how would you do this, and how would you build the sort of network and the standards and the way to demonstrate like verification and the way to demonstrate like auditability. Like there's a lot of infrastructure essentially that needs to get built, and my understanding is that's what Solo's been working on.
Yeah, it's interesting. So I've always wanted to write a little bit about identity issues.
Sure.
Because I think that's really coming up for banks in the fraud scam areas of finance. And what could happen if all of our information goes onto the dark web? Well, someone could just completely fabricate your identity or build fake identities, and scammers.
Spoiler alert, all our data is already there, and that's happening. So
so it's also kind of crazy that it feels like we've always been playing defense. Like banks have always played defense on their data and on customer data, and we haven't actually built. And then they have to build like apparently elaborate like gauntlet like challenges for people to certify their identity and verification. And then you kind of understand that like before the internet and before I could just go online and become a customer of any bank, I would just probably have physically walked into my bank, and that person would probably know me because we went to high school together. And then that kind of served as a lot of my ID verification.
It did.
And so but that's not a network. That's just like a sole branch kind of situation.
I mean, it's a very local, small network. It works well within its little confines. Yeah.
Right. And so it is it's both kind of interesting that where we are today with both the problem with all of our data has been stolen, and then also the government's going to do nothing, like give us no national identity that we could really prove who we are. So it's just really easy to make fake identities or impersonate people. And then also banks, it's the question to me, which I think is so funny, is every bank like probably thinks like their system is like really, really good. And so they kind of want to repeat the work every single time to some extent. But then also like, I think this is really interesting because it doesn't make you give up your process. It just allows you to kind of check the work someone else did. Yeah. And then you can kind of either, I mean, maybe it is 80%, right? Maybe it's 90%. Sure. But maybe it's only 20%. And like, you're like, that's really useful. We'll take it from here. But it is so funny to think a little bit about the evolution of identity in digital spaces and the problems of like, not the problem of just like, why is it so easy to steal my identity? But like, why is it so hard for banks to work together if they all have the same goal with this? And then I love this artifacts approach, right? Where it's like, you don't have to, it's not like someone else's work is not a substitute for your work. But you can just kind of check like what they, and it's, I don't know, it's almost like you're checking each other's work or you're like checking what someone else had. And like the redundancy is good. Like that actually is useful in an ID environment, right?
Yeah, no, exactly. And you know, it is interesting kind of tying it back to the last story because there's a question of how you might sort of apply standards in the right way, right? Yeah. And this to me, I think, is an interesting example where it's like, okay, we are not applying standards to how banks do customer identification programs, right? So however you want to like collect the data, however you want to sort of evaluate the data, like that's what you're doing. That's up to you. And to your earlier point, might be kind of your secret sauce or a thing you think you're really good at. Yeah. And you know, by the way, there are institutions, fintech companies, banks that sort of specialize in bringing new entities into the financial services ecosystem, right? So like there are some institutions that are the first ones doing KYC on an 18-year-old getting their first bank account. There are some institutions that do the first KYB on a small business applying for their first small business credit card. And, you know, one of the other things that I know Solo has thought a lot about, and I think is a part of their long-term plans, is how do we compensate banks for doing the first round of this work, right? Like if you're bringing...
For like certifying someone?
Yeah, well, I mean, you know, if
they're the kindergarten teacher of finance, and they're teaching us how to get in line, and
you're helping them figure out all those different things. Yeah, like how do you get paid for having done that kind of foundational work? And, you know, what's interesting is, as you said, like this is not certifying or providing standards on the how you do it, because everyone's going to do it differently. And again, it depends on, like if it's an 18-year-old, the way you have to do customer verification on an 18-year-old who doesn't have a credit report is very different than the way you have to do verification on a 50-year-old who has a full, very thick credit file, right? Like two very different processes. So you can't really standardize that. But what you can standardize is the output of that, right? What do we know about this customer? What are the different things that we verified, and what process did we use to like create the level of certainty that we have around that? Yeah. And then making all of those artifacts of the output from those processes available for others to reuse or build on top of. I think that's a very clever way of sort of scoping the standarding work to something that actually is repeatable and reusable across a large base of different. Because the other thing we didn't really talk about on the FDIC thing is, you know, just confining it to banking as a service for a second and fintech. There are so many different kinds of fintechs. There are so many different kinds of bank fintech relationships that when you try to apply standards in a global sense, it gets really hard because there's just so much variation that you have to cover. Whereas with this, the thing I like about it is it's so narrowly scoped to KYC, KYB, CIP programs. And within that, it's not built around the processes, which are all going to be different. It's built around the outcomes. Yeah. So I think that is really powerful. The other thing, and I haven't talked to Georgina at Solo about this, so I don't know if this is true, but just would be a reasonable inference is there is a rule that was implemented by FinCEN as a part of the Patriot Act, which, you know, this is going back to early 2000s, that lets banks rely on other banks' CIP work if those banks are subject to AML requirements and are regulated by a federal regulator. So, you know, banks, essentially.
Banks.
And what's fascinating to me about that requirement or that rule, which I actually have heard about for a while, right? I remember talking to a bank that was in the banking as a service space, gosh, like 3 or 4 years ago, and they were telling me about this weird rule that FinCEN created based on the Patriot Act. Is that this has been like on the books for a while, but no one has ever done it. So it's like theoretically, from a regulatory perspective, FinCEN is actually okay with you sharing your work with others or you borrowing others' work.
The first bank that tells their regulator, like, oh yeah, I'm just doing it. If the person has a Chase account, like we're good. You know what I mean?
And that's the thing that's so interesting.
Want to see it? I want to see it.
You can't, right? So like you can't say that because they're going to be like, no, you still need to do this. But at the same time, the purpose of that rule was, we know this is hard. Like the Patriot Act is imposing all these additional requirements on you to help us police all these bad actors in the world. And particularly for smaller institutions, like we know this is a heavy lift. We know it's hard. So there clearly is some recognition by Congress and by policymakers and regulators that we do want to allow some level of data sharing. The question is, how do we allow some level of it without, to your point, being just like, oh, they did it, so we're fine, and we don't even need to do any of our homework. So it's like it's almost like, how do you, maybe the analogy I would draw is like, how do you make sure someone is still doing their math homework without making them do all the long division by hand, is maybe the way to describe it. And I think this is kind of like giving someone a calculator, right? Where it's like, we're not going to make you do the long division by hand, but we are still going to make you solve the problem yourself and show us your work.
Well, and I think like what both of these stories they kind of indicate, and something that happens in my industry, because there are 4,000 banks, most of them are regulated by the state, most of them are really small. It came up with DIDMCA, national interest rate, like interest rate exportation is like, there is the digitization of banking, and I also think some of the consolidation. And it's just everything's kind of converging, and it's converging in these ways that I think the last 20, 25 years, we haven't needed so much coordinating rules or coordinating like bodies. And so everyone could kind of just keep doing what they were doing. Like, so the CIP or their own due diligence with fintechs or whatever. And then, and like we could just never come up with coordinating standards going forward.
It was all very
or convergence going forward.
To use a crypto term, it was all very decentralized, right?
Like very decentralized.
Everyone kind of just operated in their own little pockets, and everyone had slightly different kind of rules. Yeah, like that was actual decentralization, but we don't have that anymore.
But also we kind of do, we kind of don't. I think the question too is like, if we were going to bring everything together, what should that look like? What should it balance? Sure. What should be preserved or sacrosanct? But also, I just think it's interesting that the distinction between all these different banks is kind of collapsing, in part because of how digitization is changing the nature of banking. And maybe that's one thing that we need to kind of keep in mind as we think about all these different regulatory silos or different practice silos or different things that aren't necessarily technological but are managed via technology, like CIP. Yeah. And it'll be interesting. I have wanted to write about how do standards get made, because they are not like gravity, right? We don't live in a world of physics. We live in a world of state actors. And I think this is a really interesting design moment in banking of how should we design a thing that will for the next 50 years, 70 years define banking, whatever that looks like.
Yeah, I think that's a great point. I mean, it's important to put it in the context of this being a relatively modern problem, right? Because to your point, you go back in time 50 years ago, the idea of having reusable digital artifacts for accelerating CIP programs for customers that you've never seen before, but some other bank has seen before. Right. None of what I just said would make sense to a banker 50 years ago, right? If I hopped in my time machine, none of that would have made sense because what do you mean we don't already know the customer? They live in our community. Of course we would know them. B, what the hell do you mean they were already working with some other institution who's seen them first? How did they get them before we got them? they live in our community. That this is our pond to fish in. And then C, like, what are you talking about with digital reusable like artifacts? Like none of that would make sense. And
why would someone pretend to be someone that they're not?
Right. Like just none of what's the Patriot Act? Like none of this stuff would have made any sense. And so I do think like it is a distinctly modern problem. And it does feel like both between the FDIC story and then the Solo story, we are at this really interesting moment where there is this like design problem of like, okay, there's clearly a need for a new way of doing this. Yeah. Because, we are the ones who decide, right? Like the old, VC joke, like you can just do things. Like we can all just sit down and kind of map out how this is going to work. And, 50 years from now, people on podcasts are going to be arguing about like, well, where did the standard come from?
Yeah. This is like today's BSCA.
It is. And then like in the future, they're going to be like, why the fuck did they do it that way? And so like, I think that is something that I think is such a cool moment about right now. And I think it's why, even though this is kind of a niche, nerdy topic, it's why I think you and I care about it so much and why we want it to be done well is like, once the cement hardens, it's really hard to go back and change it. And so it is a really important design problem right now.
Yeah. Well, good talk on standards and back to school and
I know,
things like that.
Proud of us. Yeah.
I have a couple of other topics. So really quickly, this is kind of a continuing one. Surprising no one, there are new banks. I know that we've gone 15 years, no new banks.
Is this the segment of the podcast called Charter Watch? Is that what it is? Charter Watch?
Yeah, Charter Watch.
Okay.
Where I periodically look at the new bank charters and then I get really stressed out and I close the door and then go back to traditional commercial banks. So let's talk briefly about some new charter news. First off, Alex, congrats to baby bank Augustus, which was recently received a charter. You and I were on a fintech office hours. If you guys haven't joined fintech office hours for the public ones or the premier members, Alex does a monthly chat, and he is the one who told me about Augustus. So what do we need to know about baby bank Augustus? It's a boy,
It is. I mean, Augustus, named after Augustus Caesar, which is like inspiring or pretentious, I guess, depending on how you would view these things, is
E2.
Yeah, right. Is what is so described a global dollar bank, global dollar bank, according to their website. So it's essentially providing programmable dollar and euro accounts for global fintechs and banks. So I guess the way to sort of contextualize it is that they're trying to be sort of a 21st century correspondent bank and building sort of modern international correspondent banking-like capabilities for banks and fintech companies to use to move money across borders and do all the things that correspondent banks do, but with a very strong emphasis on technology and being sort of a tech first, tech forward. We built our own core from scratch in a modern sense to be able to do this and solve a lot of the problems that legacy correspondent banking struggles with, and to very aggressively position itself as I just sort of described, like a bank for advancing the interests of quote unquote, let's call it the West. So the euro, the dollar, strengthening the euro and the dollar globally, which is a very, I would almost call it sort of jingoistic sort of language, but something that you see in fintech, you see it in like the sort of venture capital community right now. Like it's very on brand of the moment to position yourself as like part of like the dynamism driving a revival in America and America's interests and the dollar and all that kind of stuff. So Augustus is very sort of wrapped in that language. And that's sort of wrapped in that metaphorical flag, if you will.
Sure.
And is sort of trying to build a new school correspondent bank. As you indicated, it has been approved for a national bank charter.
Yep.
So this is not a like national trust bank charter. This
Correct.
is a full OCC national bank charter.
Yep.
It is a entity that sort of came out of Europe and is more coming to the U.S., if I'm understanding it correctly. And so it already possesses some sort of European banking licenses of various kinds. So it's been around for a little bit, but it's raised a ton of money recently.
Great.
Sort of. Again, there's a couple banks, Arabor, who I don't think we're going to talk about, is another one that kind of fits into this category. But like these banks that are just absorbing these huge amounts of money from top name VC investors. And, the other little note about them that I know you'll find just fun, Kiah, is that the co-founder and CEO, Ferdinand de Bates, is 25 years old, which is... Kiah, in bank terms, very young to be the CEO of a bank. In fact, what I saw reported elsewhere is that it would make him the youngest CEO of a OCC chartered national bank in at least 100 years. I'm not sure where you looked that information up, by the way, but like that's what was reported.
You can ask John Maxfield where he
right. I'm sure he has like a database about that. So that's odd. And I guess maybe connecting to some of your other charters that you're going to mention.
Sure.
Something that is like actually relevant, right? Because one of the things that banking regulators look at with charter applications is like, who are you? What do you know about banking? Quite frankly, like, how old are you? How experienced are you?
What's your resume? Like, have you ever worked at a bank before? Are you like familiar? Yeah.
Right. I mean, it's kind of like... this is a stupid analogy, so forgive me, but like it'd be a little bit like grandparents interviewing potential parents for their grandkids. Like, hey, how old are you? How much experience do you have doing this? How responsible are you? Like, just there's a set of questions you would naturally ask before you entrusted this thing that you care about that's very delicate to this new thing. Mm-hmm. And Augustus, I think very smartly, has hired a whole bunch of people to be on its executive team, to be on its board, who have extensive experience in banking, actually working at the OCC.
Great.
And so they've sort of adopted this like, yes, our CEO is very young, but look at all these awesome babysitters that are sort of wrapped around this individual.
Love that.
Totally safe, don't need to worry about it. So that is Augustus.
The one thing I will say about Augustus is, I just wrapped up a 4-part series about master accounts.
Yeah.
And
a masterful series, if I may be so bold.
Thank you so much. If you go onto Augustus's website, they actually will several times in several places say that they have or will obtain a master account. And I was like, wait a second, I've spent way too much time on that database.
Yeah. What do you mean?
Did
Right.
I miss this? And it like on all their master account references, they have an asterisk. And then the asterisk, I think, like says like in organization or something. And which is weird because like, I guess they're a tier 1 applicant technically. And so I at the time I wasn't able to find it, but I also was like, I would not, like, I don't know, I guess having covered the master accounts for like just too many newsletters, I would not put on there that I'm going to get a master account. I guess a reading of the master account application is that if you're tier 1, you basically get it. But like, I still also don't think you basically get it. Like, I still think that the Fed is doing reviews. I think they know what's happening with these accounts and kind of, again, still want to control who gets them or doesn't get them. So I kind of just could not believe that this was like a thing they were publicly advertising. And I was just like, I don't know, man, knock on some wood there. Like,
yeah, I mean, it's like
guaranteed
talking
when it comes to a Fed master account.
Well, it's like talking about a no-hitter before the game is over. Like, you don't talk about a no-hitter, and I do think that they are doing the equivalent of that. Yeah, I'm looking at their website right now. It says Augustus provides direct dollar access through its own Fed master account, powered by a full U.S. national bank charter. No intermediaries, no middleman, full control. And it has an asterisk after full U.S. national bank charter, making it clear that charter is in progress, not fully live and non-conditional yet. And so that part's good, but they should have put an asterisk next to Fed master account, because like that, I mean, quite frankly, that deserves a bigger asterisk than the national charter, I would say, at this point.
Yeah, I guess I'm doing live fact checking right now. It does. Okay. So it says here, okay, I apologize. It says that Augustus National Bank, NA, has submitted their master account application May 12th, and it is pending, and they would be the Reserve Bank of Dallas. I'm just saying, I'm not, until I turn that account on and put some money into it, I'm not saying that I have it, right?
Well,
like,
I mean,
given the
we've
experience
talked
of
about
Kraken,
this. I was just going to say,
what is
Kraken got one. They were approved formally, and they're still not turned on.
They put out press releases.
Yeah, so no, I mean, I think it's a more than fair caution to like not count your chickens before they hatch. I mean, it's Dallas and not Kansas City, so maybe that helps, but like it's tough out there.
Okay, so the other thing we got in news is we got some rare declines.
Yeah.
Normally, and I guess the important thing is that historically, applications have been returned and then never refiled, and it allowed the applicants to kind of save face and to say, like, at this time we're just not going to pursue it. And
I wasn't fired. I wasn't fired. I quit. Yeah.
But Bunk and Wise were both declined, and I without looking too closely at the applications, I got some PR from someone who's a principal at Solomon and Edwards that said, the common message on these was that the OCC found deficiencies in governance and management. There were some issues about, the OCC's trying to be transparent, and that the OCC in these declines is showing that they are placing emphasis on regulatory risk management. So anyways, do you have any thoughts on these declines or the companies that were declined?
Yeah, I mean, as you said, that is absolutely the message that the OCC seems to be trying to send, and it is notable, right? Because they're the industry-friendly regulator, right? Like they're trying to welcome as much competition inside the bank regulatory perimeter as possible, and so it's not accidental that they are making explicit declines, not just like, oh, hey, we're just going to like not do this and you can withdraw it and kind of walk away without
we'll
getting
sit on
any
it
egg
or
on
allow
your
you
face.
to refile or something.
Yeah. Like that's, and that's a tool that they have in their toolkit too. But in the case of these declines, they absolutely seem to be trying to send a very specific message. I think we might have talked about in a previous episode some like guidance or sort of notice that they put out about like, please file your applications correctly and like do all the work. So I think that seems to be like what they're responding to is when we said we were open for business, we didn't mean that we weren't having any standards at all. And
speaking of standards,
speaking of standards, like it seems as though maybe they sort of the market picked up a message that they didn't mean to convey, which was it is a wide open door. It's a free for all. Everyone come on through. And
wow, can you blame the market for not being the most serious with these charter applications? I have no idea where they would have gotten that impression, Alex.
Yeah. And so they seem to be like, whoa. Like, it's like my parents are away and I'm hosting a party and I want it to be like the funnest party ever, but also like, don't trash my house. And so like, this is the like, hey guys, I hate to be a buzzkill, but like, please don't totally trash the house. And in the case of these specific rejections, I mean, they have a couple things in common, right? One is that, and I don't know if this means anything, but they're both European.
Which, Augustus is European.
I know, but Augustus wrapped itself in the American flag and said it's the dollar bank of the world.
Yeah.
Like it knew the right language to use. So I don't know if that has anything to do with it, but I did note that. I think more tangibly, they both had like those governance management issues that you mentioned. And like I'm looking at the stuff that Jason Mikula, our friend, posted on LinkedIn about the Bunk rejection, and it's pretty bad because it's like despite repeated follow-ups, the organizers never clearly articulated how the proposed bank would be capitalized.
I love that.
Organizers submitted revised financial projections without providing details as to the changes made and the assumptions for the revised projections. These are like kind of the do your homework before submitting an application type things.
Yeah.
Organizers provided no information as to the source and availability of the additional capital support in revised projections. Proposed management, organizers, and directors have no experience in the proposed bank's primary product, unsecured credit cards. Ooh, yeah, so that's your governance management thing. The proposed CEO of the bank has little knowledge of national banking laws and regulations.
I love that.
Proposes to be part-time. Ooh. Plans to allot a large portion of his time to entities other than the proposed bank, and plans to reside primarily outside the U.S., which kind of goes to my point about Europe. So
Yeah.
I think that, like management, knowledge of banking, knowledge of regulations, experience in these things. The Bunk one was particularly brutal, but Wise kind of got hammered on a lot of these same issues.
Wise has potential crimes. Like Wise is under a consent order and asked for a charter,
which is kind of crazy, right? And so I think that there's a lot of market participants who sort of looked at what the OCC was telegraphing and was like, it's wide open. Let's do this thing. We don't even need to hire an expensive consulting firm or legal firm to help us make sure our application is all buttoned up. Like, we can do it ourselves. We'll have ChatGPT fill it out. Boom, let's send it in. And this seems to be the OCC going like, no, that's a little bit too far. I will say, Kiah, just as a side note, as we're flagging these management and governance concerns, Dakota has applied for a national trust bank charter, which is a little bit different than a national bank charter, obviously. So there's a difference there. But I do think they're one to watch in this regard because they're like a stablecoin focused bank, and they've pivoted from doing a lot of like direct stablecoin business banking to doing more like the infrastructure for other stablecoin based neobanks. And they applied for a national trust bank charter. Mikula flagged this in his newsletter, but I wouldn't say that their like proposed board and governance structure is 100% maybe what the OCC would want to see in terms of experience and knowledge of banking and those things. It's probably not quite as bad as Bunk or some of these other ones, but it's not perfect. So I think it's a really interesting test case of like how aggressive maybe does the OCC want to be. I also think it is going to be an interesting test of like, okay, this is not a European neobank or payments company trying to come to the U.S. This is more of a homegrown U.S. crypto stablecoin type one. Like, do you want to send a slightly different message here? I noticed with interest that Zero Hash had a trust bank charter application that was returned. Yeah. So I think that you will see varying levels of aggressiveness from the OCC in dealing with these applications, depending on what message they want to send, depending on what like risks they really want to emphasize that they want you to button up, and also maybe a little bit depending on the sort of optics, location, other things that might cause the OCC to want to treat some other than others. That's what I'm watching.
Yeah, I don't have it in front of me, but the OCC also approved Sony for a national crypto charter trust, which
they did.
Like, someone flagged in the application that there might not be a promise of like parent company source of strength. Like that's normally, if you think about Sony, you're like, okay, cool, industrial loan charter, but from the FDIC and a state, but Sony didn't do that, and so that we will have a large foreign conglomerate who doesn't have to provide a source of strength for crypto trusts, which famously never have any issues because they are not really supposed to do crazy things with customer money. So I guess like we're all good there. I will say, like, you know, again, back to the joke that like reputation risk doesn't exist. Like, you know, I wouldn't want to be in the OCC's position where I have to receive kind of a bunch of applications from where I have telegraphed that I am open for business. I'm a serious person, but I'm also not a scared person. And then I have like what I would consider like kind of deeply unserious applications. I also think that if you get an application returned, you are penalty box not allowed to apply for like a year.
Makes
And
sense to me.
I don't
Makes sense
think
to
it
me.
works that way, but I guess
No.
I'm more vindictive than the OCC and I am pettier. So
Kiah is pettier than the OCC is the key takeaway. I will say another one to watch, and this is like just more of like this open. This would be a special episode of Bank Nerd Corner were this to happen. I think we could like record a special episode, but World Liberty Financial's application is still pending.
Like what? Oh, yeah, sorry. I'm gonna like short circuit, but like, why would you even put yourself in a position where you have to evaluate that charter?
Your boss didn't let you not be in that position. That's the answer to that question.
If only there was a way to kind of telegraph that, like, you were, just
they
not
have made him
really
wait.
going to-
They have made him wait for longer
Yeah.
than some of the other ones. So maybe that's like if it gets approved, but we made them wait a little longer, do we get any partial credit for not doing something crazy? I don't know.
Again, back to citing my National Trust Master Account series, one of the things that's come up is that if any of these national crypto trusts fail, the OCC might have to be the receiver.
Yeah.
Not the FDIC, which we've just seen time and time again fail banks, hand them over, like
Sure.
duck gliding across the surface, peaceful. And so, I do kind of like, I don't know, give it a couple of years. I kind of am very, very curious to see what happens. Stay tuned. Charter Watch. That was Charter Watch. We'll come back in a couple of months to see what new banks we need to welcome to the industry. Alex,
I love this segment.
before I let you go, I actually got a question from a new subscriber. When someone subscribes to our newsletters, there is a little welcome email that comes from you or me that is sent to them, and then people actually will weirdly respond back because one of the things is, what do you want us to write about? And so someone sent a question to me that I thought was really interesting, and I thought I would ask you instead of answering them.
Sure. We'll answer it live.
The question from our listener is, after 30 years in the banking industry, I continue to see a cycle of chasing fintech promises, disappointing ROI due to unrealized or unrealistic expectations for the fintech. Everyone then quietly agrees to not discuss the disappointment just long enough for the fintech fad to capture everyone's imagination. Why do banks continue to do this? They spend millions on capital projects that fail to achieve ROI pro forma promises, but then they avoid staffing a call center or branch sufficiently while facing mounting customer concerns to do so. Next question. Why do we hate headcount when it can be a great generator of revenue and customer satisfaction or longevity? So what would you tell my new listener / reader?
I think this is a fantastic question, and particularly relevant in the age of AI, where headcount versus shiny technology is like very much a topic of discussion and a decision that boardrooms all over the country are dealing with. I think the core issue from my observation, kind of sitting across both banking and fintech, is that many banks, I think, have sort of lost track of what their customers want or need from them.
Okay.
So instead of being just sort of obsessively focused on customers and building stuff that would genuinely help customers, which is, like if we think about what would actually customers want, like what would be good for customers, it's always a combination, right? It's a combination of invest in technology, invest in humans and great customer service, maybe bolster this with a strategic acquisition or partnership. Like there's never one answer. It's never just do tech or just do humans or just do M&A. It's always a combination oriented around what problem are we trying to solve for customers. Instead, banks put their energy into trying to look like they're creating customer value. So I think it's kind of this, it reminds me of that John Wooden quote, like, don't mistake activity for achievement. I see a lot of banks that have slipped into the mode of like, we want to look like we're customer obsessed rather than actually being customer obsessed. And that type of performative value creation, where you're trying to look active, you're trying to look like you're innovating, to use our friend Jason Henrich's favorite language, like you're constantly visiting the sort of innovation petting zoo and looking at these new innovations. The thing about that is if you're trying to look that way, if you're optimizing for what it looks like, right now the market really rewards the appearance of customer value that's oriented around tech innovation. So why do we discount headcount and we sort of appreciate and value and sort of overemphasize fintech, tech, innovation? It's because that's what the market sort of considers to be at a 30,000 foot level, like a sign of a good bank versus a bad bank.
Yeah.
And so,
that's the signal.
That's the signal. And so if you are trying to optimize for the appearance of creating value, it's much easier to do that by talking about AI or to be talking about banking as a service or fintech or whatever. Even if you don't really have any strategy there or know what you're doing or have a plan, even if you can't answer like why is what we're doing here going to benefit our customers, ultimately that doesn't matter because, the hope, I guess, is that bank investors will just sort of look at your comments and your strategy and your press releases and they'll go, oh, well, I guess they're doing the right stuff. So no more questions, no follow-up questions. We don't have to ask about this. And I think that is a losing strategy long-term as the question indicates. Like if you've been in banking long enough, you've been in banking for 3 decades, you've seen this pattern play out where it's like you do it just long enough for the sort of like story to kind of age out. And then you come up with a new story and you chase after a new fad. And there's kind of this cycle that happens. I actually see it a lot. And maybe this is where some banks are taking their cues. I see it a lot from the core providers as well, right? Where like they just sort of
an indictment. Okay.
Every couple of but it's like, they're in this kind of symbiotic relationship. So you see it on both sides. But like the cores every couple of quarters to every maybe 18 to 24 months at the outside, they are coming up with a new story to sell to the market.
Yeah.
Like we're doing payment orchestration. We're doing a cloud-based core. We're doing embedded finance. We're doing an AI operating system. And I think that sort of appearance of innovation language trickles down to the banks they work with. And they go, oh, well, FIS says the hottest thing right now is payment orchestration. So that's what we're doing. And it's like, are you actually? Did your customers ask you for this?
Yeah.
Is this a real thing? When is it going to be into production? Like, how is it materially going to change your business? Like, we don't really care about any of those things. And I think a good test of this premise right now is, and I'll just ask this as a question to you, Kiah, do you know of any banks who have said something like this? Our customers don't like AI. They fear it. They dislike AI. They are uncomfortable with AI. They think it's bad for the planet. They think it's bad for our society. And so we are going to loudly and proudly be a community bank that doesn't use, fund, or work with AI. Have you heard of a bank doing this?
No, actually,
Okay.
banks hate ESG, so they're looking for stuff that can like actively destroy the environment and hurt people. So
it's kind of anti right now. So I mean, to me, like that's a great signal of. I know for a fact, just looking at like the polling data on AI, there is enough consumers out there that feel that way about AI.
The data center stuff that's happening in all these towns.
It's data centers, it's fears about employment, it's distrust of the large AI labs. Like, it's just a preference for humans over AI. Like, there is more than enough backlash that already exists in the market that if a bank was actually serving its customers, some bank would take this position and be like, this is who we are. We are the bank of humans for humans, not AI. And we want to invest in our communities. We're not going to fire our employees because we could replace them with, AI agents. Like, just purely as a positioning thing, as a marketing thing, to say nothing of aligning with your own customers' values. There's enough demand out there that at least some bank or credit union should be doing that. And the fact that none of them are tells me that banks care more about aligning their messaging and the market and what it want them to appear to be rather than doing customers might actually prefer to do. And so I would is the dynamic that has kind of crept into banking over the last, especially couple of decades. And, again, like another test of this is look at like Chase, right? Who's the bank that's talking loudly about building branches, hiring more employees, doing all that? Like, who's cutting against all these narratives?
Who's investing in communities and
And like, who's doing the stuff that's sort of unpopular among investors kind of at a surface level?
Yeah.
It's the bank that doesn't have to care about what investors think about, right? Like, Chase doesn't care about like tying itself to these like momentary trends or whatever. Like, they'll talk about AI, they'll talk about tokenization, they'll talk about tech things too, but like, you don't see them chasing the tail of we want to appear to be doing something. They are actually thinking about where they want to deploy their resources strategically for where it will actually lock in their value and create more value and lock in their position in the market. And I think that's another test of like, if you don't care about what investors really think and you're confident in your own business, you might be investing in headcount. You might be investing in branches. But I think many, many banks that don't have that luxury are more optimizing for the appearance of innovation.
Okay, this is a long podcast. I'm sorry, everyone. Hopefully you've enjoyed it. My answer is, I think, going back to, again, my observation about our design moment.
Yeah.
So much of banking historically has been done in person and paper-based. The technology was the spreadsheets or the computer or the internet. Mm-hmm. And then, the pace of technology has increased. And I think that banks have not strengthened the muscle that allows them to do project management. Whatever the project management muscle is, or implement
product development.
Development, product management, implement things, execute things, fix them if they're not delivering, and figure out why. And I wonder if they've never had to do it, or if they had to do it, but it was like really simple because it was like paper based, or it was like the move was like hire a person, fire a person. And so now, because they don't have this like culture to do that, because they're like the way they did business didn't require them to do that. And the other thing too is most banks have like legacy profitability. So they have long-term customers that they're able to make money from. They have legacy infrastructure. They have legacy branches, legacy tech. And so, and that they haven't made decisions when it was easier, and now they have to make a decision when it's harder. Like one of the things that I've been thinking about from a technology perspective for banks when it comes to like AI, or when it comes to like these like kind of platform infrastructure firms, is like, in the future, aren't you going to be bigger and have more customers, and this is going to be more annoying, right? Like,
totally.
wouldn't it make sense to kind of do this now and kind of like, be able to sandbox it a little bit? Or, I was just talking to someone in New Hampshire about like, they were talking about like, they have an end of life core. They have an end of life core issue. They might have 20 years of runway on it. And they're like, what should we do? And I was like, well, something you would maybe do is like a sidecar core. And then you put your new accounts on it. And then you put like a new product line on it. And then you slowly migrate. Like, I don't know how you'd pick and migrate, but like you would just give yourself as much time as possible. But you have to do that. Like, I don't know if the sidecar core is even the right solution, but like whatever you need to do, you probably need to talk about it now, and then set yourself some deadlines that correspond to your core dying. Right. And like, also, none of it's going to be fun. It's all going to be scary. But like, I would at least, if the one thing I get to control is time, then I would do that. But, and then focus on like, how can we get our ROI? How can we make the most out of this decision? I also think, like, to your point, like there is so much signal, and sometimes like you and I write in a way that we're engaging with hype and signal, and then we have to be like, okay, let's go down to the level that has the facts. Let's go down to the level of reality.
Let's like filter this down. Yeah, we talk on the show occasionally about like stablecoin crypto stuff. Like, is there a there with stablecoins? Yes. Is it buried under many, many, many layers of hype and nonsense that you have to wade through to get to the actual thing? Yes. And so like there are banks out there that are doing really smart stablecoin things that are like completely hype free and very oriented on customer value. But I can tell you, those banks had to wade through years of nonsense and, to your point, build the muscle memory to like get to that point.
Yes.
That is like, it's the muscle memory, I think, is a really good analogy, where it's like another way of thinking about this, take Stripe as an example. Like some outside observers might ask about Stripe, like, how is it that they're able to go from like cards payments, which is what they started with, to crypto, to AI? Like, how are they so fluidly able to kind of move from one era of technology to the next? And the answer is that they have built an internal sort of set of muscles for product development, technology, customer needs discovery, like all of these different things that are fungible between different technologies, right? And so like when the environment changes, like when the environment changes, they're not thrown off by it because they're like, oh, well, we can just apply this discipline we've built internally over here.
Yeah.
So I think it's a great observation that banks just got so stuck in the one mode of how banking worked that now as it's become this business that changes more dynamically, you don't have the muscle memory built up. And so, yeah, your example is perfect. Like, if you're scared of a core conversion, if that level of like work scares you, and it's a lot of work to be totally fair, but like if that level of work terrifies you and you're like, we can never do that, how are you going to adapt to AI?
Right.
How are you going to adapt to these things? Like, if you can't do that, if you don't have the muscle built up internally to do that, it's really hard to do other things. So I think that diagnosing that underlying deficiency is really important.
Someone once told me that the way he defines culture is the way we do things around here. And
that's good.
And like the premise of the question of like banks chase fintech promises, they have disappointing ROI because they had unrealistic expectations, they didn't execute or didn't implement, didn't use it fully, didn't utilize it fully. No one talks about it, and then we will copy paste repeat.
Yeah.
That's culture. That is an articulation of a culture. And so like you can't get different if that's how you do things, and if that's good enough, and if that's how we will approach these things. Like, of course it's going to happen again and again and again. I wouldn't say hire, I wouldn't say branch, I would say fix that. Like, fix any of the actions in what you just talked about, and then don't act like this is immovable. The only thing you can do is change yourself, right? And so like, that's I just was like kind of fascinated, but then like I'm both empathetic and then I'm totally frustrated with the premise. So
yeah, no, well, I mean,
that's my work
sounds like,
as a
it sounds
writer.
like it sounds like the person who asked the question is also frustrated with the premise. And so like it's always a challenge when you're stuck in that, like, this isn't how we should be doing stuff. And then you see the same pattern play out over and over, and it's like the definition of insanity is like doing the same thing again and again and expecting different results. And so I think culture at the root of all of that is exactly the right diagnosis.
All right. Well, Alex, I'll let you go. We're gonna record one of these podcasts this fall live. Hopefully our producer will be there, Josh. we'll Skype him in. But it was so good to talk to you, and safe travels.
All right. You too. Enjoy it.